Let's begin with today's session. And I hope everybody managed to mark their attendance by now. All right. Okay. Good. All right. So the plan for today. Right. Good. So the plan for today is as follows. So we'll mainly split this session into two parts. In the first part, I'll quickly revise the basic valuation technique that you have already learned in part one of this term. So we'll try to go through that relatively quickly. And then in the later part of today's session, I'll introduce you to the portfolio theory. So we'll look at the effect of diversification on risk. Right. Okay. So from term one, the purpose of capital markets is to allow investors to make their investment decisions. So capital markets bring together the users of funds with those who have excess funds, right? So the surplus units as well as the deficit units. So it's a platform, it provides a platform where surplus units and the deficit units come together and exchange securities. So typically in capital markets, we deal with two main types of securities, equity and debt. Okay, and I quickly summarize the difference between equity and debt in the last session as well. So capital markets, what is the key characteristic of capital markets? First and most important key characteristic is that these are long-term, right? So the instrument traded in capital markets are typically long-term. They have a long-term investment horizon. Okay, and in terms of the instruments that are being traded, the most well-known instruments that are being traded in capital markets are stocks and bonds. Okay, so we'll start with a quick valuation of a bond, and then we'll look at the stock valuation. So there isn't going to be anything new here because you already covered this, but because we want to move to portfolio theory, right? So you need to select assets to be included in your portfolio. So that's why I quickly wanted to go through how to value these assets, the two main asset classes, debt instruments and equity instruments. So we'll quickly go through this and then we'll move on to portfolio theory. Okay, so the basic valuation technique, right? What is the basic valuation technique? So how do we determine the price of anything? What's the formula? Do you know what's the formula for that? So present value is the price today, right? Price of any instrument, any asset, right? So what is the price today? So you can write P naught or present value. Okay. So how do we determine that? How can we determine the price of any asset? Okay, what's the definition of present value? From anybody? Right? No? No one? Yeah.
Basically, you have to reduce it by the, for example, if it's after 5 years, you have to reduce it by 5 factors, like by the, what's it called, interest rate, or not interest rate, I think it's the rate of, not really sure, the currency that's switching.
Right. Okay. Good. Right. So present value is simply the discounted value of all the future assets. So how do we know what is the value of an instrument, right? So we need to know how much cash it's going to generate, how much we are going to get in the future, right? Okay. So what is the price of the asset let's say that generates a cash flow, and let's, for simplicity, we'll just take one to begin with, right? So this instrument pays this cash flow at time one, right? So if this is the cash flow at time one, what is its value in today's term, right? Because this is a cash flow at a time into the future. Its present value might be different, simply because of the time value of money, which you have covered in several other modules, as well as in the, in the first part of this module, right? So this is cash flow into the future. So what do we need to know? We need to know its value today. We are going to discount it at an appropriate discount rate, right? What is that discount rate? So you can use any symbol to represent this. I like to use R, right? But you can use any other symbol, right? Okay. So cash flow 1 year from now discounted at this required rate of return, right? So that will give us the value of this cash flow in today's terms. Is that right? Okay. So you know this, right? Okay. So cash flow, that's you're expected to receive in year one. What is, how much is it worth today? It's the discounted value at this appropriate discount rate. So what is this appropriate discount rate? What is this appropriate discount rate? How do we know what is the appropriate discount rate? Okay, so I came with this understanding that we know all this, right? Okay. So can somebody help me with this? What is the appropriate discount rate? What do we understand by the term appropriate discount rate? Anybody? Okay, so somebody's not going to volunteer, then I have to ask someone, right, randomly. Okay, so appropriate discount rate. Anyone want to say anything here? What does appropriate discount rate mean? So is it like 5%, 10%, 7%, 50%? What is it? Yeah, it's the rate of return, but what is it? Appropriate. What does appropriate mean? What does appropriate reflect?
Is it the interest rate on the asset?
Very good. So it could be the interest rate on the prevailing interest rate, right? Okay. Anything else? Is it appropriate? Is interest rate an appropriate discount rate? Inflation, right? So inflation. So from earlier modules that you've taken, we know inflation and interest rates are linked, right? So interest rate, the nominal interest rate at which you typically use for discounting, right? So this R could be interest rate, but we know inflation and nominal interest rates are linked, right? So what is nominal interest rates? It's inflation plus something, right? Okay. Right. So again, what is appropriate mean here? And the appropriate discount rate. So R is a discount rate. Uh, one measure of this R is interest rate, right? Okay. Somebody raise a hand somewhere. Okay. Anybody else? No? Okay, so this discount rate, the appropriate discount rate should be reflective of the riskiness of the security. So how do we know whether we should discount it at risk-free rate or whether we should discount it at the required rate of a commercial paper or at the required rate of 10-year bonds or the required rate on a swap? How do we know, right? The rate that we're going to use should be reflective of the riskiness of that asset, right? Okay. So this cash flow that's going to take place in year one, right? We need to know its present value today. So how much should we pay today to get this cash flow in 1 year's time? So in order to get its present value, we need to discount it at an appropriate discount rate, and this appropriate discount rate should be reflective of the riskiness of that asset. Right? So this is 1 year, right? So I can easily change it to multiple periods. Okay, so all I have to do, so this could be like 5 year, for example, right? Or I can change it to more generic cash flow for n periods, right? Okay, discounting for n periods, summation. So we need to add, right? I is equal to 1 to n. So we need to add all of the discounted cash flows, right? So if it's for 5 years and it's 5, so you will have 5 cash flows. You're going to discount each of these 5 cash flows at the appropriate required rate of return and then sum them up, right? This summation sign is simply dependent on the number of years, right? So you'll sum up the present value. So present value, what's the formula here? How do we read this? Present value, or the value today, or the price today, is simply the sum of present value of all of the future cash flows, right? So that's the basic present value formula or pricing formula, right? And I'm sure you have used it like multiple times in the exams and or multiple uh, in the multiple modules as well. Okay, so as I introduced using this term required rate of return, this required rate of return should be reflective of the riskiness of the asset. So how do we determine what is the risk level? So discounting takes into account a number of factors, right? Okay, so from this formula, you can actually see present value today will be a smaller value because it's going to discount the future cash flows. But why do we discount the future cash flows? One main reason for discounting all of the future cash flows is because the value today is greater than the value that you'll get with the same amount of money at some point in time in future. So this is the concept which we call the time value of money. So what is it? It's the basic notion that a dollar received today is worth more than a dollar received at some future date. So for example, $100 today are worth more than $100 in a year's time. So would you prefer to have $100 right now or $100 in a year's time? So all of you should choose to have $100 right now, right? So why would you prefer to have $100 right now? Because the value, things that you can buy with those $100 today would be greater than the goods that you can potentially buy with the same $100 in 1 year's time, right? And why is that? One key reason is inflation, because over time, due to inflation, prices go up, right? So something that costs you, let's say $10 today or 10 pounds today, you may not be able to buy the same quality, same good of the same quality in a year's time, because in a year's time, price of that particular good might have increased due to inflation, right? Another reason that we need to take into account these differences in timing of cash flows is due to the foregone opportunity, right? What is this foregone opportunity? It is basically the opportunity cost, right? So if you have $100 today, for example, right, rather than having $100 in a year's time, if you have $100 today, what the least you could do is to put it or invest it, right? Put it in a bank or some other investment opportunity, right? And if you deposit that, let's say $100 today, and assuming there's an interest rate of 10%, that $100 in a year's time would translate into 110. right? And so you can see if you, instead of having $100 today, if you have the $100 in a year's time, you're £10 or $10 worse off because you could have invested those $100 today and those would have translated into 110 in a year's time, right? And the last reason to discount or to take into account the time value of money is risk. So how is risk related here? Anyone? So it's easy to understand, inflation affecting the prices, time value of money, important. I've explained the foregone opportunity, the opportunity cost. That's why you need to take into account the time value of money. So what about risk? How does risk affect how is risk related with time value of money? It's simply the risk that you might not get the cash in the future, right? It's the uncertainty. Okay, so if somebody owes you some money, right? So there is a risk that the other party may default, right? The further the cash flow into the future, the greater the uncertainty. Okay, so the main reasons we need to take into account this time value of money and we need to discount the future cash flows are these following: inflation, opportunity cost, and the risk that the expected cash flows may not materialize. And it's because of these factors, right? It's these factors, right, that will determine this R, the required rate of return, right? So for example, if you invest in a bond, cash flows of a bond are certain, right? We know in advance how much we're going to get, right? Let's say a 5-year bond that pays 10% interest. So you know at the time of the contract, when you purchase a bond, you know that the bond is going to pay 10% interest, right? So you can calculate the interest cash flow with certainty, right? Similarly, because it's a bond, it will pay up the initial principal payment right at the end, at the maturity of the bond. So you can see cash flows for a bond are certain. So one element of risk gets reduced in the case of a bond because these cash flows can be measured with some degree of certainty, right? Okay, but if I ask you to tell me the cash flows associated with a stock, right? So with a stock, the cash flows also become uncertain, right? You don't know how much cash the firm is going to distribute in the form of dividends or in the form of repurchases. Okay, so let's just quickly use this formula to value a bond. Okay, so here we have, or a loan, right? Bond is a loan, right? So here we have a simple loan of $100 when interest rate is 10%. Okay, so we can calculate the present value uh, of $1 into the future using this formula. So this is done on a $1, right? So what do we call this? What is this term here? Present value of future $1. You know this, right? Okay, what is this? This is present value interest factor, right? The tables that you have been using. You know the present value interest factor table, right? You've used it in the exams. Okay. So if you can calculate it on a $1, that's, those factors are calculated on a $1 basis. And all you have to do is to multiply it with the, cash flow. Right. Okay. Good. So, so here we have this simple loan which pays interest rate at 10%. So which means you'll give $100 today. So if you're giving this, like investing $100 in that loan opportunity or a bond, right? In 1 year's time, it will give you 110. right? So again, you can see the cash flows are certain here, right? Okay. So 100, interest rate is 10%. So in 1 year's time, this value of 100 will increase to 110. So original 100 plus the interest of 10, that makes 110. And if you keep that invested in next year, that 110 will earn an interest rate of 10%. Okay, so the interest in year 2 will be 11, right? Because it not only earned interest on the original $100, but it also earns interest on the 10 interest that you earned in year 1. Okay, what do we call this? What do you call this? Earning interest on interest? Sorry? Compounding. Very good. Okay. So earning interest on interest is what we call compounding. Good. So you can see, if you invest $100 and that investment pays off 10%, so you can work out the future value that you're going to get in, let's say, n years, right? Okay. Good. Okay. So let's look at yield to maturity. So what is yield to maturity? It is basically the required rate of return that would equate the future discounted value that will make the future cash flows. It is the required rate of return at which you're going to discount the future cash flows that would make the present value of those future cash flows equal to today's value. Right, okay. So it's the interest rate or the required rate of return that equates today's value with the present value of all future cash flows. So again, if we work with the same example, so if we have a simple loan uh, that pays or that requires an interest rate of 10%, right? Okay. So if that pays 110 in year 1, right? And the value today, price today is 100, so you have to work out I. The I that would make this 110 in year 1 equal to 100 today is your required rate of return or your yield to maturity, right? So essentially, it's exactly the same formula, right? So what do we have here? We know the present value today is 100. The future value in 1 year's time or cash flow in 1 year's time is 110. So what do we need to work out? This R. What is this R that would make this 110 in year 1 equal to present value today, which is 100, right? Okay. Good. So if you work out this I or R in this example, that turns out to be 10%. Okay. So what I want you to do quickly is this example. What is the present value of 250 to be paid in 2 years if interest rate is 15%? Okay, so what do you have to do? Calculate the present value or the value today, right? Okay, what is the present value of 250 to be paid in 2 years if the interest rate is 15%? Okay, can you work out the present value for this? I'll give you like 30 seconds to do it. Okay, so if I say you need to do it, you do it, right? I know you know it, but let's do it so that you can provide me with an answer. So can I say the same question differently? So how much would you be willing to pay today to receive 250 in 2 years' time? Right? It's the other way to say the same thing, right? How much you're willing to pay today to receive 250 in 2 years time, right? Okay, so it's 30 seconds, right? What did you get? Sorry? You don't have a calculator? You have this device, right? So I told you if I say that you need to do it, you need to do it, right? Doing it, you'll get paid 189 for that time. Very good. How about you? Guys, still talking, right? Do you want to stay in the class or do you want to go out? Both of you. What's the, how much do you think? It's in the slide, right? You didn't calculate it, right? You, one, you do it. Okay? And do not talk, right? All right. Okay, good. Right. Okay. So how many did you get? What was that thing? All right. It's fine. Don't worry. I'm not going to tell anybody else. Okay. Good. Right. Okay. This is taking much longer than I expected. Right. Okay. Good. So what do you have to do, right? So 250, there's this formula, right? Again, this formula. We're getting this 250. So future cash flow or future value is 250, right? But that is at time 2. So you need to discount it at 1 plus the required rate of return. Required rate of return here is 15% to the power 2. Okay, 1 plus 15% to the power 2. And that gives you, okay, 189, right? I think only one person did it correctly. Right? You know, one person gave me the correct answer. Others must have done it correctly as well. Okay. So 189. So in order to get 259 today, if the required rate of return is 15%, to get 250 in 2 years time, you only need to pay 189 for that 250 that you're going to get in 2 years time. Right, okay. So that's investing in bonds, right? So bonds are easier to value because the cash flows are certain, right? The required rate of return is also relatively easy to approximate, right? Okay. But when it comes to investing in equity, that makes things a lot more trickier. Okay, so let's quickly look at the key characteristics of equity. So one key characteristic of equity, it represents the ownership in the firm, the proportionate ownership in the firm if you invest, if you hold a certain percentage of stocks of a particular firm. But unlike bonds or loans, where the only form of return is in the form of interest that you earn, you can earn return in 2 ways in the form of stocks, right? So the typical way stocks provide return is in the form of dividends, right? Dividends are paid to owners of the stock or stockholders. So dividend is essentially a cash flow, right? And what is the value of a stock? What should be the value of the stock? The price of the stock? It should be the discounted value of all of the future cash flows. The cash flows for a stock are dividends, right? Okay, so instead of cash flow here, you'll have dividends, right? Because it's essentially the same formula, right? So dividends are cash flows, and you need to discount that back to get the price of the stock. But dividend is only part of the return, right? Another part of the return, if you invest in stock, is in the form of share price movements, right? So the price of the stock can appreciate or depreciate, right? So there are 2 components to return in the case of equity investment. One is in the form of dividends, the other is in the form of capital gains, which reflect changes in price over time. So stockholders have claim on all assets of the firm, right? Stockholders or shareholders have a claim on all assets of the firm because these are essentially owners of the firm, right? Okay? And because they are owners of the firm, they have the right to make decisions with respect to the firm, right? Okay? So the ownership stake comes with this voting right. And this voting right allows them to take part in the decisions of the firm. So stockholders, shareholders get the right to vote for directors and on certain issues. And it's through these directors or managers that they run the firm. Okay, so uh, in equity markets, there are two main classes of stocks: the common stocks, which represent the residual claim on firms' assets. If they come with the right to vote, they're entitled to common dividends. And then there is a hybrid kind of security, which we call the preferred stock. So preferred stock have characteristics of both debt and equity. Okay. So priority claim. So if you are a preferred stockholder, so they get a priority claim on firm's assets as compared to common stocks, right? Common stocks will get whatever is left after everybody else is being paid, right? So claim of preferred stockholders come prior to that of common stockholders. These preferred stockholders are entitled to preferred dividend. So preferred dividend is more like interest on loans. Like interest, which is predetermined at the time of the contract, preferred dividend is also predetermined, and it's also fixed, just like interest. So you can see there is some similarity of preferred stock with dividends, uh, with, with, uh, with debt. Okay, and these do not usually have a voting right. Okay, good. Um, so what are the advantages of equity from a corporate finance perspective, right? So if I give you this option that you have to choose between a debt investment or an equity investment, right? Which one would you prefer? I asked this question in the last session as well, right? Okay, so most of you went with debt, right? Okay, so I assume that would be that would apply today as well. Right, so if we look at the characteristics of equity or its advantages, right? So equity, although the least favorite, equity is advantageous from a corporate finance perspective because it does not require a payment, right? No repayment is required. Companies do not have to repay shareholders their principal investment, okay? In the case of debt, the companies are obliged to repay the principal investment as well as the interest. But with equity, uh, that's not the case. So there's no extra burden borne by the company. Increasing equity does not increase the risk of bankruptcy, right? What is the risk of bankruptcy? That the company may not be able to pay interest or principal payment on time, right? Okay, so it doesn't add the risk of bankruptcy. No, it does not require monthly repayments like interest. Okay, so if it doesn't require monthly uh, repayments, which means the firm will have more capital that they can invest and use for other purposes. And lastly, the risk is shared. Shareholders share risk and only receive dividends when the company generates positive earnings. Okay, and companies can raise substantial amount of funds by selling their shares in financial markets. So you can see there are a number of advantages of raising capital to equity, right? If you are a manager in a firm, you might prefer to use equity for investment purposes, right? Okay, good. So here's this question that I just asked you. So if you are a manager of a firm, right? If you are the CFO or finance manager of a firm, how would you raise capital for your firm? What would you prefer? Would you prefer debt or would you prefer equity? Okay, if you are a manager of a firm, right? So you have to give the answer from the perspective of being the manager of a firm. What would you prefer to do? Would you, so let's say you have a really good investment opportunity, and let's say you need 100 million, right? So how are you going to raise that 100 million? Are you going to use debt or are you going to use equity to invest in that positive NPV project, right? In order to generate some value, you need to invest first, right? I already told you that the project is positive NPV, right? So which means the value that you get will add value to the firm. Given that it's a positive NPV project, you need to invest 100 million. How are you going to raise it? Are you going to raise it with debt or are you going to raise it with equity?
Well, if the amount of the project is actually 100 million, I'd assume that raising the amount by debt would decrease my overall NPV afterwards when I have to repay it. So I'd rather choose equity.
Okay. Okay, good. Just a minute. Okay. So I just made this example, right? It doesn't really have to be 100 million, right? It could be any other number. It could be like 100,000, for example, right? If I say it's 100,000 instead of 100 million, will your answer change?
If it were a lesser amount, I would probably choose debt because
Okay.
choosing equity would, if my firm's private at the time still,
No, we're talking about corporations, right? Unlike public American companies, right?
yeah, they're not right.
Because private firms will not have publicly traded equity stocks.
Yeah.
Okay, so we're talking about.
That's what I mean. That's what I mean. So raising my firm's still private, and like the whole process of
Yeah,
initial public offering is an issue.
so that's out of the question, right? We're talking about corporations, and that's why we have a choice between debt and equity. Okay, but like instead of 100 million, it is like 100,000, then your answer changes, right?
Probably,
yeah. Yeah. Okay. Good. Right. You want to say something? Okay. 70% debt and 30% equity. Okay.
You get a tax shield when you raise money by debt.
Very good. Yeah. Excellent. Okay. One key advantage of raising money through debt is that when you raise money to debt, you have to pay interest, and interest is tax deductible. Interest is treated as an expense, right? So it reduces your tax liability, tax burden. So that's one key advantage of that, right? Very good. Okay, so given that interest provides you tax shield, so you might prefer to use debt, right? So you would prefer debt, right? Is that right? Okay. Anybody else? Yeah. Very good. Good. Perfect. Okay, so we're getting closer, right, to the point where we are talking about the capital structure of the firm, right? So you must have learned capital structure, right, in some corporate finance, right? Is that right? Okay. So what she is alluding to is that we need to choose an optimal level of debt and equity, right? Okay, so debt has some advantages, equity has other advantages, so we need to find a balance, right? So we can increase debt up to the point where it helps us reduce our tax liability, but at the same time, we need to take into account that as you increase debt, it makes the firm more risky, right? And once the firm becomes more risky, it has an increased bankruptcy risk. So the discounting will be greater, right? So here you can see in this formula, if a firm has a higher bankruptcy risk, this R needs to be raised to reflect that higher risk. Okay? So you would go for an optimal capital structure, some portion of debt, some portion of equity, right? Okay? Good, very good. So some of you will choose debt, some of you will choose equity, some of you will choose both debt and equity, right? Okay. Good. All right. Okay. So you know about this trade-off theory of capital structure, which is what she just mentioned, the trade-off theory of capital structure, that we will use that as long as it adds value, and the value comes in the form of interest tax shield, right? But if you add too much of a debt, then you are adding cost to it in the form of increased bankruptcy risk. Okay, so you have to balance off, the benefit of interest tax shield versus the cost of financial distress, and where the benefit is exactly equal to the cost, that's the optimal point, and that's what you need to do. Right. Okay. But you're in the, you're not in. So here, we'll just we'll look at the same thing with slightly differently, right? So that is absolutely correct. All of you are correct, right? So you can choose debt or equity or a combination of these two, right? But for any sort of financing, you would have to go to the market, right? So let's say I'm the finance manager, right? And I have to raise some amount of money, and I have to decide whether I'm going to use debt or equity. Okay? So now I want you to assume the role of investors. Okay? So I'm the manager, I'm the firm. I'll come to you and ask for some money. And you have to decide what you are going to do. You're going to give me a debt. So if you're willing to give me debt, then I have to issue debt. Right? If you're willing to invest in the equity, then I might issue equity. Right? As a manager inside the firm, I would be happy to issue more equity because it doesn't commit resources, right? Because I do not have to repay interest at fixed intervals of time. So I will have more flexibility. I might choose equity, right? Okay. Good. So if I tell you that I have a really good investment opportunity, we're going to make a lot of money by investing in a company, right? Okay. And I ask you to invest in a company, what would you prefer to do? Would you prefer to invest in that? Would you want to give me a loan, or would you like to invest in the equity? So those of you who would like to give me a loan rather than equity, okay, raise your hand, like higher, right, where I can actually see that, right? So those of you who would invest in that, okay, good, 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 good. Those of you who would invest in equity, okay, very good. I messed up. I wanted equity. Okay, all right. Okay, in the first session, I did ask you that when I ask you a question, it's like a yes, no kind of question, or you have to make it twice. I expect everybody to give an answer, right? So I'll give you 30 seconds to think about this, right? And I want a decision from everybody. Okay, there is no right and wrong answer. At times, all I want you to do is to think about it as a potential investment opportunity, and what would you prefer to do. Okay, so I expect an answer from everybody. Okay, so I'll give you like 30 seconds to make up your mind whether you would invest in debt or whether you would invest in equity. Right. Okay. And you know the problem. The firm, has a really good investment opportunity, and I need funding for this. So you have to decide whether you are willing to give me that money in the form of a debt or in the form of equity. Okay. All right. Good. I hope everybody made up their minds. So those of you who will invest in debt, right, like this, right? Debt investments. Okay. Good. All right. Okay. Equity. Equity investments. You. Okay. Good. Good. Very good. Okay. So it's roughly equally split, right? I think. Good. Okay. Right. So those of you who would invest in equity, right? You invested in equity, right? Why would you invest in equity? Yeah. Yeah, very good. Okay, so if it adds value to the firm, you might be better off investing in equity, right? Okay, but how do you know it's a good firm? How do you know I'm telling the truth? How do you know that it is actually a good I really have a good investment opportunity, right? Okay, if I'm the CEO or if I'm the manager, right? You know, I can say, okay, I need X amount of money. We have lots of amazing projects coming up. We can do all the amazing things, and we're going to generate so much return, right? And all of you will be super rich as well, right? If you invest in my company, okay. So I'm telling you all of this, but how do you know if I'm telling the truth? Once you give me the money, right? I can buy a private jet, right? With that money, right? I can do that, right? Okay. It's your money, but I would have the control of it, right? So what do we call this? Uh, True, but I was referring to the fact that it's your money, but I will have the control of it, right? Agency, very good, excellent. Okay, so because of this agency issue, right? Okay, so it's your money, but I have the control. I decide what to do with it. So I can buy a luxury office, right? I can stay. I can set up meetings in Hawaii and fly in private jets, right? But there might not be any good investment opportunity at all. Right? Okay, so you have to think really, really carefully whether you would be willing to invest in debt or whether you'd be willing to invest in equity, right? Okay, so this is what you need to know from a financial markets perspective. That if the firm really has a good investment opportunity, right? If the firm really has a good investment opportunity, it should issue debt. Why would the firm issue debt? A bit louder. Because that's cheaper than equity. True, true. Uh, yeah, that's one of the reasons. Yeah, good.
Less risk, and you don't really have to do research about what the company is and everything, so it's less time consuming. You can just issue it.
Good, very good. Another advantage of that is that it can be issued more quickly. That is easier to issue, right? That is easier to issue. You can issue that more quickly instead of asking lots of people to invest. You can just go to a bank and raise them more quickly. Yeah. Yes, but that may not be a good thing for me as a manager, right? Because then I have to manage my cash, uh, more tightly. Make sure that I will generate enough cash and I have to repay those cash, right? Okay.
And if you service by debt, then they have greater ownership, so they get greater rewards for their money, and they're not giving up equity in the business. So if the returns are profitable, they make greater returns.
Very good. Okay, that's exactly what it is, right? He might not have said it appropriately, but I know what you mean, and that's exactly true. So if the firm really has good investment opportunity, it would go for debt. The reason it would go for debt is because the shareholders have the residual claim on assets, right? Whatever is that. If the firm generates a lot of money, firm has a lot of, a really good investment opportunity, right? So why would it be willing to share all of that value that the firm is going to generate with new shareholders? It would not, right? So existing shareholders would like to capture most of that value, okay? And by issuing debt, you give a fixed claim to the debt holder, irrespective of how good you do, right? If you're making a lot of money, right? If you're generating a lot of cash flows, how much would you pay to debt holder? The same fixed interest. So the shareholders will get all of the remaining. Okay? So if there is actually good news, if there is a good positive NPV project, firms will prefer to use that and not equity. Okay? Because they can give a fixed return to the debt holders and keep all the value that they're generated for existing shareholders. Okay? Good. So if you follow this argument, right? So this is what we call, you know, so besides the trade of theory, we have another theory of capital structure which we call the technical theory, right? Okay. So if the firm really has good investment opportunities, it should finance those first with internally generated funds, the firm's own cash reserves. Okay. Because in that case, it's not sharing anything with anybody. Okay? But if the firm's requirement for investment is greater than what the firm currently has, then the next step would be, after using internally generated funds, the next step would be to go to debt. Okay? And if the firm still has more requirement for additional funds, only then it should go to equity. Right? So you should see this from a signaling perspective. If the firm really has good opportunity, it should first try to finance it with its own funds and not sharing with anybody. The returns, the value generated as a result of that opportunity, it should keep it within the firm and share it only with the existing shareholders. But if the requirement of investment is greater, then you should go to debt. So we share a little bit with the debt holders, a fixed claim with the debt holders, and retain everything else. Okay. But if you still need more, only then you would issue equity. Right. Okay. So in financial market, stock valuation is the method of calculating theoretical value of the firm. Okay. And by firm, you can translate the value of the firm on a per share basis, which we call the stock price or the value. So you can use these valuation methods to determine the value of a stock. So valuing common stock in theory is no different from valuing debt securities. So this is what I told you. The valuing equity is essentially the same formula, except that the cash flows change the form. So instead of cash flows, which are here in the form of interest, in the case of debt, they will translate into dividends in the case of equity and changes in stock price, which we call um, the capital appreciation. Okay. Good. So it's essentially the same formula. So you need to determine the cash flows. You need to determine the discount rate, and discount those cash flows at the required rate of return for that particular stock, and that will give you the present value or the value of that stock. So in terms of the trading strategy in stocks, it's quite simple. Stocks that are judged to be undervalued, you should buy them, and stocks that are judged to be overvalued, you should sell them, right? So using this formula, you can determine the price of a stock. And if the price of the stock at present is lower than what you determine, then it's undervalued. So you should invest in that stock, okay? Because currently it's trading below its fair value. Right, okay, so here's the same formula, right? So this is the simplest model. So what do you have? Expected dividends, right? So you have expected dividends, okay? And the other thing you'll get is when you sell the stock. So you'll get P, right? The price of the stock, but the price of the stock at some future time might be anything, any number, right? Okay, so when you sell, so if you hold the stocks for some time, you are entitled to dividend plus any price when you'll sell the stock, the price that you'll get when you'll sell the stock. Okay, so you can think of this more if you try to compare this with the cash flows of a bond, right? So dividend is you can try to see it in terms of valuation formula as interest payments. And P is the principal payment at the end of the debt term. Okay, so what do we have here? Cash flows in the form of dividend and the price you will get when you sell the stock. So these are cash flows, and what you have to do, you have to discount them at the required rate of return. And the discount rate here, I represented it with the term KE, which is the required rate of return on equity. Okay, so what is the price of a stock with an expected dividend and price next year of expected dividend of 16 cents and price of 60 in the coming year. So if we use a 12% discount rate, can you calculate the price of this stock, right? Okay, so my understanding is there was a question like this in the exam as well. So the price of this stock is simply the present value of all of the future cash flows, right? So what are the cash flows? You'll get dividend in year one, plus you'll get the selling price of the stock in year one, right? Selling price is 60, dividend is 16 cents. So that's the total cash flow in year one. And all you have to do is to discount it at the required rate of return, which is 12%. And that gives you the price of the stock today. So the price of this stock that pays a dividend of 16 cents and that will be selling at $60 in a year's time should be selling at 53.71 today. If the price is any different than this, if the price is any other number than this 53.71, then what do we have? An opportunity to make some money, right? If currently the stock is less than valued at 50, right? What should you do? What will you do? You should buy the stock because its real value should be 53, and you know the price will go up. Okay, the price should adjust. Okay, if it's trading above its value, then you should short sell it. Okay, good. So this is the formula that you have seen in the previous session, previous term, right? Okay, so essentially, so what I'm trying to do, the reason I'm spending so much time here is so that you can see the similarity. That it doesn't matter whether it's a debt or equity. The underlying technique is the same. It's the present value of all of the future cash flows. The cash flows, the nature of the cash flows will change depending upon the type of the asset, but the underlying technique is the same, right? It's simply the sum of the present value of the future cash flows. So here you can see, what do we have? What is the price of a stock? It's simply the sum of the present value of all of the future dividends, right? Because the stock return would be in the form of dividend. Yeah.
We could know the price at like the next year for the following year because it's estimated. But what if we're like keeping it for 5 years? How will we know what the price will be at like after 5 years?
Yeah. Okay. Good question, right? So the question is, we can estimate the price 1 year into the future, but how would we estimate the price of a stock that's 5 years or 10 years into the future, right? Okay, so the answer to this question is that we cannot even determine the price of the stock 1 year into the future. We can have an approximation, an idea, right? But that is not guaranteed. So the example that I had, it's an example to show how the formula works, right? It doesn't mean that the stock would definitely have a price of 60. Okay, it's to show you if the stock value is 60, how much you would be willing to pay for it today. It's the application. It shows the application of the formula. But determining the exact value of a stock at some point in time in future, it's really hard. Okay, you can have some approximation, but it will never. It will be extremely rare that you will end up with the same number. Okay. But again, the technique is similar. So it's essentially this formula. So I can say the same. I can ask the same question differently. Okay. So I can say if the price of the stock today is 53, right? What will be the future value in years time? It's just rearranging the same formula. Okay. Good. All right. Okay, so you can see this is exactly the same formula. It's the what's the price of a stock? It's the discounted value of all of the future dividends. Okay, and then this is the derivation of the formula that you have seen in the previous term as well, and I'm sure you have gone through all of it. Okay, so I'm not going to go through the derivation of it again in the interest of time. Okay, so once you, okay, let me just mention one key point here in terms of the derivation, right? Okay, so you can see, it's, as I said, this is the sum of the, what is the price? It's the sum of the discounted value of all of the future cash flows, right? But it's not only the dividends, we know that there, you will have to sell the stock at some point in time, right? So it should be the price P at the end as well, right? Okay. So if you look at this formula, so it's D1 dividend in year one, dividend in year two, and so on up till year end. Year end could be at any point in time in future, right? So if the dividend, so in final year, you'll get DN dividend in year end, but you'll also get the price in year end, right? Okay, good. So it's similar, right? Dividends that you're getting plus the final payment when you sell the stock. Okay, so but that's at time n. So if this n is large enough, if you look at this formula, if you make n large enough, right? What will be the present value of that p n? Yeah, zero. Yeah, close to zero, right? Negligible. Because the further the cash flow is into the future, the greater the effect of discount, right? So if Pn is way into the future in terms of its present value, that will be negligible, right? That will be so small that it would make no effect. Okay, so that's why. So if we raise it to already infinity, right? Okay, so here in the formula it says t time period 1 to infinity, and if n is very large in terms of present value, this becomes zero, right? Because of the effect of discounting, right? So if you do all of that, uh, okay, so this is what you are left with, which you call the Gordon's growth model, right? Okay, so what is the price of a stock? It's the dividend next year divided by required rate of return on the stock minus the expected growth rate. And what is G here? The expected growth in dividends. And here in this formula, we assume that the stock or dividends will continue to grow at a constant rate. Okay? Good. So all of you have seen this earlier as well, right? Okay. But in addition to this method, there are other methods that we use. So we can use some sort of multiples. The standard multiple that we use is price to earnings. It could be book to market, or it could be any other multiple to come up with the price of the stock. Okay. Good. All right. So that's about valuation, right? So you can see the core of this, all this is that we can determine the value of any asset. It could be debt, it could be equity, it could be some hybrid security. What do we need to do? What do we need to know in order to value any asset? So if you look at this formula again, in order to know the value of any asset, what do we need to know? We need to know the cash flows, right? We need to know the timing of those cash flows, right? And the last factor that we need to know is the appropriate required rate of return for that asset. As long as we have these pieces of information, we can determine the value of any stock or any asset. Okay, so now we know how to value debt, how to value equity. So now we can go to portfolio formation. So what is a portfolio? A portfolio is simply a combination of different assets. Okay? So what do we call a portfolio? A combination of different assets. In a portfolio, you can have assets from the same class or you can combine assets of different classes. So you can have an equity portfolio in which all assets are equity. You can have a debt portfolio in which all assets have characteristics of debt. Or you can have a portfolio that has both debt and equity. Okay? So portfolio term simply means combination of different assets. But when you look at portfolios, these are the questions that you need to consider. Okay, why should we create a portfolio? Right? Why should we create a portfolio? I've given you the answer on the slide. Risk reduction. When you create a portfolio, it reduces the risk. Okay? How does it reduce the risk? Okay? So I'll explain how does portfolio reduce the risk. Uh, the idea of portfolio is, based on common sense, and I'll show you why it's based on common sense in a minute or two. Okay, so the first question to consider: why should we have portfolios instead of investing in individual stocks or individual bonds? So the next associated question is: if you want to create a portfolio, which assets would you like in your portfolio? How would you choose assets? Okay, which assets to include in your portfolio? And how are you going to select those assets? Okay, so that's the next question that you need to consider. Okay, what else you need to consider? If you do want to create a portfolio, how many assets would you want in your portfolio? Is 2 enough? 100? 50? 45? How many? Okay, good. How many assets would you consider? Okay, the next question is, should we combine different classes of assets, such as debt and equity in a portfolio? Should we combine different assets? Or should we just keep the portfolio pure with a particular class of assets? Okay, and besides these, are there any other factors that we need to consider when we are creating a portfolio? Right, okay, good. So as I said in the beginning, so we'll focus mainly on, we spend a lot of time on the valuation of assets because that's important. You need to be able to value the asset first before you move on to combining these assets. Okay? Good. All right. Okay. Was it not sharing my screen? Right. Let's see if. Let me see. Okay, let's see if it's capturing this. Yeah. Okay, good. Right, so we just talked about portfolios, right? The portfolio is simply the combination of different assets. Okay, so it's called modern portfolio and capital asset pricing theory, or in short, sometimes we use it. We use the term modern portfolio theory. The term modern uh, um, may may not be quite relevant now because this modern portfolio theory was first presented in way back in 1958 by Henry Markowitz. Okay, so this is what we have. So let's see how portfolios work and what are its benefits. So what do you see here on this slide? So on the horizontal side, we have number of securities, and on the vertical side, we have standard deviation. What is standard deviation? Standard deviation is a measure of standard deviation is a measure of risk, right? Standard deviation is a measure of risk. Okay, and on the horizontal side we have number of securities. If we have just one security, right, our standard deviation is the highest. But as we add more securities, you can see the standard deviation goes down. Okay, standard deviation goes down as we add more securities. And adding more securities meaning we are creating a portfolio, which is combination of different assets. Okay, good. So you can see that as we add more securities into our portfolio, the risk gets reduced. What do you think? Is this true? Or should this be true? Right? Should the risk go down as we add on more securities? What do you guys think? Okay. Why? Okay. So each individual stock will have its own risk, right? If you're just adding them up, right? Why would the risk go down?
I think it depends on like the diversity of your components of the portfolio. Like if your stocks in the portfolio are diverse enough, some like a risk that impacts one of the stocks or like one kind of the stocks that doesn't impact the others. So the risk is definitely reduced.
Yeah, what does diverse mean here?
Sorry.
What does diverse mean here?
Sorry.
You said the stocks that you will have some sort of diverse.
Stock, different kinds of stocks, stocks belonging in different like all firms in different industries.
Yeah. Okay. So it could be stocks of. Yeah, I mean you can have different stocks in different industries, right? The question is why isn't the risk adding up? So why is the risk going down when we're adding more securities?
Because different kinds of risk affects stocks of firms in different industries have different margins. So it's not just one kind of risk.
Yeah.
For example, something that affects real estate doesn't affect technology necessarily.
Yeah. Yeah. So you're saying it's a different kind of risk, right?
Yeah.
So one stock might have exposure to risk factor 1, another stock might have exposure to risk factor 2, right? But that still doesn't answer the question. When you're adding those stocks up, there should be risk factor 1 plus risk factor 2, right? Yeah? That's my question, right? Okay. So do you think as we add more securities to our portfolio, the risk should go down? Right? The risk should go down, right? So this should, yeah. Right. So, so this, if this is true, right? If this is true, then all of us should be doing the same thing, right? Then all of us should be adding more securities. All of us should be creating portfolio because by creating portfolio, we are reducing the risk, right? Okay. If this is true, right? Okay. Why does portfolio reduce risk? Right? It's very simple logic, right? You should not put all of your eggs in one basket, right? If you put all of your eggs in one basket, right, then what's going to happen? She's going to tell me. If you put all of your eggs in one basket, what's going to happen? All right? Yeah, why? Yeah. Okay, so if you put all of your eggs in one basket, and if you drop the basket, right, then you break all of your eggs. Right? Okay. So what is diversification? You should not put all of your eggs in one basket, but spread them across baskets. So it's very simple, common sense approach. Okay. So that's the underlying idea of diversification. Spread your investments across different assets, across different baskets. Okay. To reduce the risk. Okay. So the next question that I ask you is, asked you, what was the next question I asked you on the slide? If you want to create a portfolio, right? Which assets are you going to choose, right? And how are you going to choose those assets? Right. Okay. So there are different ways to create a portfolio or diversify. So if you look at this simple way of presenting diversification. So in the first case, what do you have? Spread your eggs equally across as many baskets as possible. So it's a very simple 1 over n rule. If you have like n eggs, right? Oh, sorry, if you have n baskets, right? Okay, so you'll put this 1 over n in each basket. Okay, so you have to identify how many baskets you have and just spread your eggs across each basket equally, right? Okay, but it is quite possible that some baskets might be stronger than others, right? Okay, so the risk that a particular basket might break, would depend upon the strength of the basket. Okay, so the other approach would be use as many baskets as possible and find the best number of eggs in each basket. So this was presented by Henry Markowitz. So you can identify all of those baskets where you can put your assets, put your investments, okay? But you may not be interested in investing in all of these baskets, right? In all of those assets. So what is he suggests that you need to identify the baskets first. Okay, so use as many baskets as possible and find the best number of eggs to put in each basket. So the idea here is that once you have identified all of the investments that you want to invest in, all of the assets that you want to invest in, then you would have to choose how much you're going to invest in each of those. Okay, so in one basket you can, let's say, invest 50% of your investments, in the other 12%, 5%, right? So you identify the basket first and then decide how much you're going to put in each basket. And the last approach is find the best basket first, okay? And then worry about how to spread your eggs. So first you have to identify the correct assets that you want to invest in, and then only think about how much you're going to invest in each of those assets. Okay, so let's stop here and then we'll start from here next week. So the material here is for 2 weeks, week 2 and week 3.